Good afternoon. Welcome, everyone. My name is Watson McLeish, and I serve as the tax policy lead here at the U.S. Chamber of Commerce in Washington, D.C., where it is my pleasure to welcome you to this timely and informative session on the Employee Retention Credit, also referred to as the ERC in this presentation. Recognizing the unprecedented challenges that faced many small businesses in maintaining operations and retaining employees throughout the COVID-19 pandemic, Congress enacted a range of supportive tax policies, of which the ERC was a major component, and why we're here today. During today's presentation, we're going to delve into the intricacies of the ERC, explore whether claiming it might be the right choice for your small business, and understanding some of the intended benefits and risks. Navigating the complexities of federal tax incentives can be quite overwhelming, including for tax lawyers like myself. So I've asked today's guests to help demystify the ERC and hopefully equip you with the knowledge needed to make an informed decision about whether it's appropriate to claim it for your small business. Before I welcome our experts, however, I'd like to encourage everyone attending to please engage actively in today's discussion. You can ask questions and otherwise just take full advantage of the expertise that we have for the hour. You can ask questions at any time during today's program by using the chat feature on the right side of your screen. And the panelists and I will address those questions toward the end of the presentation. So without further ado, I'd like to introduce our guests for today. We have two senior practitioners from Experian Employer Services, whose job it will be to help you understand the eligibility criteria, the potential benefits, and processes for claiming the Employee Retention Credit. Matt Kelly is Vice President of Tax Consulting Solutions at Experian, and his colleague, Adam Taplinger, is Director of Business Development. Gentlemen, the floor is yours.
Good morning, good afternoon. This is Adam Taplinger with Experian Employer Services. Thank you so much for taking the time to meet with us today. With me is my colleague, Matt. We're excited to be here and present to you. I'm going to give just a quick overview of the ERC program, and then we'll dive into a little bit of details. We're going to save a lot of time for your Q&A. So we're going to make our informatory session at the beginning brief, just touch on some high-level points. A lot of you here may have already have some familiarity with the program. So we're just going to dive into a high-level overview, and then we'll open it up to Q&A very soon. And let's move forward. Perfect. So title of our presentation, should you claim the ERC? It's topical. We get a lot of questions about the Employee Retention Credit from a perspective of, hey, I've heard about this. I don't know if I'm eligible. I get 500 phone calls and 500 emails a day. And a lot of the folks that we hear that our clients connect with maybe can't answer the questions in a way that satisfies the answers they're looking for. So if we can move to the next slide. So a little bit about us, Experian Employer Services. We are part of Experian. Experian, as most of you know, is a consumer credit bureau. That's where most of the employees sit, is on that consumer credit side. But within Experian, our division is called Employer Services. We have about 1,000 people. And at our core, we're a tax credit consultancy. And what that means is we work with companies ranging from small companies to the Fortune 500, helping them determine, analyze, and claim tax credits and refunds that they may be eligible for under certain federal and state programs. And so just to dive in on what the employee retention credit is, why does it exist? So the employee retention credit was passed in early 2020 as a reaction, frankly, to some of the uncertainties that COVID had brought, and so it was a time of just a lot of unknowns. And so Congress passed this law with as part of the CARES Act with tremendous intent, and that intent was to support businesses and to be able to continue to operate despite these uncertainties with respect to the pandemic, with respect to governmental restrictions that were resulting from the pandemic, and then frankly not knowing what was going to happen next. And so the ERC was passed in early 2020, but has also been amended 3 times since then in various pieces of legislation. And so without getting into too much detail on that, this was passed at the first passing of the ERC. The passing of the original ERC and the CARES Act was really intended to help companies weather the storm. And so Matt will go into a little bit about what makes a company eligible and a little bit more about the credit itself.
Yeah, thanks, Adam. And if we look at, the legislative history on the ERC is extremely interesting and telling. It actually came out as a somewhat more conservative version of what many advocates were asking for at the time, and also modeled after, this idea of having an employee retention tax benefit is not new, really modeled after some of the disaster zone tax benefits that have been around for years related to natural disasters, the fires, which are tragic out in California, as well as the hurricanes, especially in the Gulf Coast and the Southeast. So it is, as most tax legislation is, kind of a beg, borrow, and steal from other provisions as it evolved into what we have today, which we'll get into. So eligibility requirements are obviously very important to all businesses. I think, Adam, you would agree that what we see is that too many businesses and too many providers tend to oversimplify the eligibility requirements, or frankly misstate them, and then end up taking advantage of this credit when they maybe shouldn't, and creating some audit risk, some exposure that could be very costly to the employer in the long run. This was intended, as Adam said, to provide some economic stimulus to weather the pandemic, the financial environment caused by government orders shutting down parts of the economy. It was kind of a compromise. The government acknowledging that it needed to step in and restrict commercial activity, and then providing this tax benefit to offset the impact to employers as well as possible. Certainly not perfect, very difficult to pass something that quickly, especially when, as Adam said, passed in March of 2020, when everyone thought the pandemic was going to last for a couple of weeks. We just go home, we stay at home for a few weeks, we come back out, everything's fine. Years later, we're still dealing with the effects of this pandemic, and will for many more years. And so this isn't meant to criticize legislatures or anyone else. It's just meant to say, like, in the lens that they had at the time, we'll be providing some of what they were trying to do. So in order to do that, they provided this 2 paths to be an eligible employer. One path is objective and mathematical. That is, if you can demonstrate that you met a certain decline in gross receipts compared to a pre-COVID baseline, using 2019 gross receipts as a baseline, compare that to your quarterly gross receipts in 2020, for example, or 2021, and did you meet this decline metric? And 2020, for example, comparing Q3 of 2020 to Q3 of 2019, that metric would be a 50% or greater decline in gross receipts, which is a high bar. Not a lot of employers met that. In 2021, when they extended and modified the ERC, they were much more generous, frankly, and they lowered that bar of 50% to 20%, again, using 2019 as a baseline. So that changes depending on the year you're in. So there's that gross receipts requirement. Fairly straightforward, especially compared to the next one. but certainly not always easy when you're looking at aggregated group, looking at the gross receipts from all of your combined groups. Your spouse or your partner has another business on the side that may need to be included with that revenue. You have a common owner that maybe resides in Brazil, and you've got to look at all the different entities that Brazilian parent company owns within the United States. So that can get complex, but certainly much more straightforward than option 2, which is where a lot of people have been achieving eligibility, is in option 2. So option 1 is this gross receipts test. Option 2 is you may not have met the gross receipts test, but can you demonstrate that you were fully or partially suspended, that your business operations were fully or partially suspended due to a government order? We could spend the next 3 hours unpacking what those few words mean. We won't, but just keep in mind that's very subjective. The IRS has provided hundreds of pages of guidance that don't answer all the questions. Frankly, sometimes the IRS guidance raises more questions than it answers. But thinking about your business, was it at least partially suspended due to government order? And that can be, maybe it was modified in a way that's not comparable. And then the IRS, as we'll get into, has introduced these ideas through notices. Notices are very interesting. They're published by the IRS. They certainly carry a lot of authority. They're not binding on the taxpayer. They are binding on the IRS because the IRS issued them. So they basically said, here's what we think it means. So they'll be held to that. They're not necessarily binding on a taxpayer, but as what we've seen with audit activity, the auditors are basically taking the notices as their rule. So you're going to have to navigate those because that's how the IRS views the ERC. In those notices, the IRS has introduced another element to this partial notion, this partiality, this partially suspended, and that is, well, great, you've been partially suspended, but was it a more than nominal impact to your business? Meaning, partial by definition is more than zero, anything more than zero, but the IRS has said, hey, maybe 1% impact to your business isn't enough. They've suggested that you need to have a 10% or greater impact to your business, and they've given a few examples of 10% of your gross receipts was impacted, 10% of your employees were not able to work, or really what they said was employees were working 10% less hours than they normally would have worked. Could be a more than nominal effect. And that more than nominal standard comes in multiple times. It's looking at different parts of your business, and is that part of your business more than nominal to the rest of your business? And then do you have a more than nominal impact to your business? So this eligibility requirements, as you can see with us taking a very shallow dive here, can get complicated very quickly. And for an employer to say, look, I have this stay-at-home order, and so people couldn't come into my ice cream parlor because they were told to stay at home, so I got less foot traffic. I got to be eligible. I'm going to go ahead and file for this credit. I would say you may not. Like, you really need to look at this. There's a lot that goes into that analysis, and it's much more complex than just saying, I know there's a stay-at-home order out there and my business saw less foot traffic, so surely I qualify. There's some risk there and some red flags that need to be observed as you navigate those analysis on eligibility. Adam, what are you seeing as you do, because you, especially working with companies day in and day out, you probably talk to 10 or more companies a day. As you look at eligibility, they're talking to other providers, they're talking to their friends who claim the credit. What are you seeing, and what are some of the common misconceptions as you deal with eligibility?
Yeah, so Matt, that's a great question. And well, to answer that question, I'm going to just bring everyone back in time to go through the sequence of what happened with the different stages of ERC with respect to legislation. And when the law was originally passed, it's important to recognize that there was a very, very significant prohibition that once that prohibition changed, the landscape completely changed for the employee retention credit. And initially there was a prohibition for companies that had received PPP to also claim ERC. That was a blanket no. That was a hard no claiming ERC if you took PPP. And so at the end of 2020, as part of the omnibus extension to the budget, Congress thought that they should make the ERC available to more of the constituents to really get the economy moving, because as Matt said at the beginning, ERC the pandemic didn't last 2 weeks. It lasted, well, for everyone on this call, it's a little different, but it's lasted a long time. So December of 2020, that prohibition is removed, which set a couple of things in motion. But it wasn't until the ERC was extended later in 2021 that we see the nature of this sector change, of this business, of what we do change. Because at the beginning, if you think about who was eligible for PPP, it was any business that was fewer than 500 employees. If you had a company that was over 500 employees, you were not eligible for PPP, with the exception of a couple of SIC codes that they excluded. But our client base at the beginning of this was really large companies, 500 and over, no PPP. Well, now December of 2020 comes and that gets removed. But the ERC is still relatively small at that point because it's limited to 2020 only. And it's a credit that's a maximum refund at the time of up to $5,000 per employee, which is really nothing to sneeze at, but not exactly where it went. And so once Congress expanded ERC in 2021, a couple of things happened. So first is they extended it, and I don't want to confuse too much on this call, but it was expanded to all 4 quarters of 2021, and then it was actually cut out of one of the quarters. So it's actually now 2020 as a year and 2021 as 3 quarters, Q1, Q2, and Q3. And the numbers got big, right? So the maximum amount that you see advertised, that you see Mr. Wonderful and all of these folks advertising and promoting on TV, is a maximum of $26,000 per employee. And that incentivized many folks that wanted to be processors to jump into the market. And so what we're seeing, and what we've seen really since 2022, is this influx of providers and providers with a lot of capital to really put out some really interesting, kind of fun ads, but advertising that we don't necessarily agree with content. But what we see from the perspective of, let's call it, levels of acceptable risk for what we would present to our clients, we're looking at providers that are that are advising their clients to. I'll give you an example. I spoke to someone the other day, and it says, "Well, look, I had somebody call me up the other day and tell me that because I had to wipe down my desks at my office every few hours, that I'd be eligible for ERC." Now, that sounds ridiculous, and it is ridiculous. And so we see that type of advice. I don't know if you'd call that advice, but we see that type of analysis, or not lack of analysis, really, with a lot of the folks in the market. So part of our job is to educate, and it is to have our clients, as best as we can, help them understand A, the narrative, and B, the intent, and C, the IRS guidance, right? Because once everyone understands that story, we can start to really talk about, to Matt's point, what creates eligibility for ERC. And it is now a very generous credit. It's a substantial credit. But what it's not, and Matt will go into a little bit more on this, and he touched on it before, but what it's not at its core is it's not free money from the government. That's the wrong way to look at ERC. And I had a conversation just this morning with someone that said, look, if there's something available to me, I kept my folks employed as best as I could during the pandemic. I kept paying wages as long as I could for as many people as I could. These are the facts of my business. These are the things that happened to me. I had to close my doors. I had to open up with social distancing. And if there's money available to me for making these decisions that Congress had intended that I make in order to continue to try to employ the people that meant a lot to my business throughout a period of hardship, then I want to take it. But if this doesn't add up to an ERC claim as outlined by Congress and as enforced by IRS, then I don't want to take it. And that's what the ERC is, and that's what it's not. And Matt, I don't know if you had anything to add there, but that's what I see.
Yeah, absolutely. I can add a little bit to what it's not. For example, what it's not is it's not an income tax credit. It is a refundable payroll tax credit. It's really as close as you get to a cash grant that can be passed through a tax vehicle. And a lot of the reasons they did that was because it's much easier under certain budget limitations and rules in the House to pass things as a tax benefit than it is as to earmark money for cash grants. So it's a refundable payroll tax credit, not an income tax credit, but not also a cash grant, and not just free money for everybody that applies. It's also not discretionary, meaning I see, for example, some questions often about what if the IRS denies my claim? What if they don't agree with me? Well, they can, but that's through an audit. They're not going to review your application, look at your facts and circumstances, and decide whether to give you your money. We'll get into that a little bit more later in the audit discussion, but you're really claiming the credit on your 941, at this point, your 941X, because it's an amendment of a previously filed 941. And so it's not a discretionary grant where you're writing a grant application hoping they agree with you and you're competitive with others. It's also not necessarily a finite budget here. It's not like once they've hit a certain budget, they're out of money and they can't fund the ERC anymore. We get that question often. We'll get into that a little bit. It's kind of been this weird place where, as Adam said, towards the end of 2020, when this was set to expire per the legislative language, December 31, 2020, it was considered undersubscribed. They didn't have nearly as many applicants as they thought they would. Now, what we've learned in retrospect is this was largely in part to the IRS being so far behind on processing it that they had no clue at that time how many claims or the volume of revenue that had been requested under this program. So they extended it, made it more generous, but they didn't assign a budget cap to it. Because it's a refundable payroll tax credit, I see, for example, a question, can you claim ERC for contractors? They have to be a W-2 employee that you withhold payroll tax on behalf of. If they're not, then you're not going to have anything to refund there. You can't clearly claim a credit on a contractor because they're not your W-2 employee. You're not paying payroll tax on that employee. You're not withholding payroll tax or remitting it on your 941. So it really is limited to employees that show up on your 941 with payroll withholding obligations. That's what it is. It's also not, I would say this, it's not easy. It's just not. We often get employers we work with that are frustrated for how much time it takes to do the analysis. It does take time. There are a lot of questions. There are a lot of different ways to look at it. The more audit activity we see, the more questions we have, the more of a sense of what the IRS is looking for. So absolutely a generous credit. Absolutely a wonderful opportunity for many employers who are using it the right way. But like with any tax benefit, beware. Why don't we go to the next slide and talk about some of the risk and the current risk environment. Adam, we have some headlines here. This is just obviously a sample. There's a lot of news and media coverage here. How have you seen this coverage shift as you are working in the market, as you're talking to employers day in and day out? How has the tone or the attitude shifted towards this credit, so let's say a year and a half ago versus now?
Yeah, Matt, that's perfect, right? Because what happened was, as we discussed, as these new providers came into this market with aggressive stances on ERC, a couple of things happened. One is this advertising that sounded too good to be true. It really is too good to be true. And then second to that, it generated some interesting decisions to be made from the IRS, because the IRS they do have a tough balancing act, right? So there's Congress who passed the law and has the intent of the law in mind, to get stimulus funds to its constituents, and the IRS's role is to interpret that law, which was written very quickly and amended very quickly, and typically laws aren't passed like that. And so what we've seen are these, just call them providers in the market, generating this noise. And the noise is creating this reaction, a fair reaction from IRS and saying, look, be careful of these providers, because you as a taxpayer are on the hook if someone does the work and they didn't do it properly. It's still your return. It's like anything else. Just because you had someone help you doesn't mean they knew exactly what they were doing. And so what's shifted is, the ERC, if you really look at it over 2 years, there's been no material guidance passed since 2021, but there have been notices posted by IRS around caution, diligence, thoughtfulness, and Matt will get into some of that in a second. But really what it comes down to is it's almost like a buyer beware. That's what we've seen shift in the market. If you're going to claim this, burden is on the taxpayer to do it properly. And what we've seen here is a change from the beginning, where there were a lot of early adopters to this ERC program and said, hey, I want to just grab this as fast as possible. This is great. I'm going to go figure it out and ship it in and claim my credit. Now, the folks that haven't claimed it, we sometimes find are and there's no right or wrong here, but just a little bit more diligent, a little bit more thoughtful. And the environment now is, for our clients specifically, we hear a lot more of, I want to do this right. I want to do this once, and I want to really minimize any downside risk. And no downside risk can be fully minimized to zero. But we know the audit rate is extremely low today with the employee retention credit. But the work product that we pride ourselves on is we just assume everyone's going to get audited. So that way, our deliverable is tight to the statute, to the guidance, and to the fact pattern of the company. And that way, if the company ever does get audited, we're there to respond and to help. But that's how we've seen the landscape shift from I'm going to grab this while it's there, to I want to really make sure that this is the right thing for me, because I'm a little skeptical about free money from the government. And so, Matt, what have you seen here?
Yeah, so I agree. That's exactly right. We're seeing people become more cautious. We like, as you mentioned, we like cautious clients. We do not want to have people who are kind of wild cards there. We appreciate a healthy sense of paranoia dealing with the IRS. It's how it keeps you alive. I have personally spoken to IRS auditors on this over the past 3 years. I've spoken multiple times to Treasury, to the people who drafted the notices, with many questions. And I will say, oftentimes the answer is, Matt, we don't know, do your best. There is a lot of gray area with this sentence, partial suspension due to a government order. Exactly what rises to the level of partial? What is a suspension? Can that be a modification of my business where I had to have 6 foot distancing? Maybe that is enough. Maybe if you had to observe 6 foot distancing, social distancing in your business, that does. It doesn't always. What is due to? How proximate does the relationship have to be between the government order and the impact to your business? Sometimes it's difficult to separate why your business suffered. It may have been all due to one government order, or it may have been a combination of this order and how it impacted you, but how it impacted your supply chain, and upstream and downstream. That supply chain argument is very interesting. The IRS introduced it in their notice, but they seem very comfortable that it's only if your supplier was impacted. If who buys your product is impacted, they don't seem as comfortable with that. Not sure why. We haven't really worked through that with them yet. I'm sure many of this will be litigated with the IRS eventually. And then what's the government order? The IRS has been very clear that strong suggestions don't count. It's got to be an order, and it has to be from a governmental authority. General guidance from health commissions may not count. So unpacking that sentence inherently has a lot of gray, subjective interpretation involved in it. The key to success, we hope, is taking reasonable interpretations, being able to stand in front of an auditor, or eventually maybe even a judge, and say, look, this is what the language said, this is what the IRS guidance said, this is what happened, this is a reasonable application of all of that to my business. Yes, an auditor may disagree with me, but absolutely it's a reasonable interpretation of what was out there at the time. And when we were interpreting it, this is what everyone thought it meant. We've seen that a lot. Give you an example of some of this gradation. I was working with a project yesterday where you have a government order from a state governor, official letterhead, I hereby order, and then the next paragraph says, I hereby order that I strongly suggest that everybody observes social distancing. Well, what is the business owner to do in 2020, 2021 when that's issued? If they consider that an order, they adhere to it, they don't want liability, they don't want to be sued, they don't want to get in trouble. But what will an auditor do having 3-4 years of hindsight at their benefit to say, well, it did say strongly suggest after a said order, so we're going to consider it this. There's a lot here. In our experience working with IRS auditors, we have had to educate them quite a bit, to help them understand the context, to help them understand that in the fog of war at the time, there were a lot of decisions being made by business owners trying to be responsible, trying to adhere to the guidance as best of their ability that did impact their business. So there's a lot to unpack there. This shifted significantly in this current environment, partially because there was a lot of fraud here. Similar to the PPP, but the IRS already identified more than $1 trillion of fraud related to the ERC. That fraud was generally companies like maybe even foreign entities setting up fake U.S. corporations, running fake payroll, trying to claim the credit that way. Usually pretty easy for the IRS to spot that because they can run that up against the 941s that were filed, W-2 data, all that kind of stuff. So there was already a significant amount of fraud with this. And then when the IRS starts hearing, as Adam called out, these radio ads and these TV ads that are running during the Super Bowl, if y'all probably saw that last year, promising $26,000, just give us your payroll, in 5 minutes we'll have a credit for you. That put the IRS on edge. The other thing that has created this current environment is CPAs understandably have been very uncomfortable with, they'll tell their clients, hey, be careful here. And the client goes to somebody who says, hey, it's easy, I'll do it for you, no problem, give me 25% of it. And then that client goes back to the CPA and says, hey, you're a knucklehead, I got it here and it was no problem, why don't you understand this stuff better? And this poor CPA is thinking, hey, I do understand it better. You've done something that's created risk, now we're gonna have to deal with that. If you get audited, it's gonna be a nightmare. And so there's all this tension out there that has been created from this credit, which has created an environment where the media, the Wall Street Journal, the New York Times, the Boston Globe, all these major publications have picked it up and said, beware, be careful of this. There is good money here. There is a good opportunity here for employers that are eligible, but there's a lot of risk here. There's a lot of misinformation floating around. So that's the current risk environment. We're going to move on to the next slide, Adam. Maybe you can kind of walk us through, you already referenced this in your last comments, this importance of properly documenting and presenting the claim that you're making, right?
Yeah, so the important thing to know about the ERC, and we get questions on this all the time, is, well, and I think there's even a question in the Q&A, what happened? How does this work? Well, this gets filed and the IRS pays it. And that's how it works, unless the company owes some kind of back payroll tax. As far as we know and we've seen, there's not methodology review at IRS. It's just is this a real business? Do the 941s match up? Does this appear to be legitimate or some kind of fraud? And then a check is cut. And so the bar to claim the ERC is set very low. And what we've seen, and for an example that I saw about a year ago, there are certain options for financing and lending that folks will provide, and you may see that as well on ERC claims. So if you claim your ERC, there's financing firms out there that will help claim it. And one of those financing firms had sent something to us that we didn't prepare, and I reviewed it, Matt reviewed it, and we looked at it. And we looked at the documentation that the processor had put together. And it was a little frightening because it was a really large claim in an industry that we wouldn't necessarily think would be a terrific candidate. And it was quite simply just cutting and pasting statute, a state statute, without any support on how the business was impacted. And that was the basis for which this company filed the claim. And there's nothing to stop them from doing it. And the IRS doesn't like that, right? Because this is going to get paid, most likely. And then when it does get paid, and if it does get flagged for audit, there's going to be a time for a reckoning as to what was done and what was prepared. And the IRS has given really clear guidance, and Matt will go into what that is in terms of what should be thought about, documented, and presented, frankly, contemporaneously with the filing of this claim. Whereas there's some type of disincentive for folks to just go ahead and write a number on a napkin and ship it in. And so we could go through, Matt will go through the details of just on a high level of what those steps are.
Yeah, and so as Adam said, the IRS provided guidance in the notices early on, that were released in the early 2021 that said, here's what we're going to ask for. And on the screen here, we have a screenshot from an actual IDR that we've received, giving example questions, and it's pretty much verbatim what they said they were going to ask for. So they've done a good job about putting everyone on notice of what they want to see documented. You're going to need to be able to show your gross receipts analysis. You're going to be able to need to show your payroll analysis. You're going to need to show the actual orders that you're saying suspended your business. You're going to need to show how they suspended your business. You're going to need to show the more than nominal impact. And now they're asking, hey, who is your provider? And did you rely on a provider? Who was it? Because they're really out there to say, who's doing this, and are they doing a good job at it? And so there's going to be more of that. There was a comment in here earlier about what if you think you made a reasonable decision, or the IRS disagrees with you? Are there going to be penalties? What's the issue? I think the IRS is going to be generally very understanding if employers made mistakes on this credit, and especially if they relied on bad advice. So they're more worried in those situations, I think, are more focused on trying to go after the provider than they are the employer, if the employer is relying on bad advice. Now, they're going to use, as they always do, was it reasonable to rely on that advice, or should you have known better? But certainly making sure this documentation is in place. I'll give you a good example, using us as an example. This morning, I reviewed a memo that we were writing for one of our clients. We usually try to document our files with memos. And it wasn't bad, but it just lacked detail. And so I kicked it back and said, look, I get that there was a building capacity restriction of 50% in place for this time period that impacted their sales, but we got to be able to prove that. We got to be able to show that even at 50% capacity, does that matter to that employer? Some employers only get like 1 or 2 people in their shop at any given time if they have a brick and mortar. So when they could have 30 people in there, so restricting them to 15, maybe it matters, maybe it doesn't. You need to show that it matters. And so that's going to be important. Is there data that can show that? Do you track foot traffic? Do you track sales? Do you track sales projections, and your sales team couldn't do their meetings and conferences were canceled and trade shows were canceled? Great, we can prove that those were canceled, that's helpful, but then the IRS and the more than nominal is going to want to know, so what? How did that impact your business? Did it even have an impact on your business? You can show me the trade show was canceled, but maybe you can't prove to me that that mattered to your business revenue, or your actual marketing. Maybe you just go because everybody else goes. Sometimes that's very difficult to prove. We get that. We work with employers day in and day out, thousands of employers. We understand that can be difficult to prove, but you need to think about how you would have that conversation with an auditor, and how would you demonstrate that to an auditor? Even if it's a narrative, how would you tell that story to an auditor? And can you back that story up with data? That's going to be needed in your documentation as you're presenting these claims. Presentation is also important. When an auditor initially looks at a claim during an audit, and they ask some questions, if the taxpayer is unsure of the answer or doesn't have documentation in place, human nature is going to be the auditor assumes they haven't done it right. And now they got to dig out of a hole. Whereas if you come out of the gate with, hey, here's what we did, here's our documentation, here's my analysis, here's my memo in the file, let me know if you have any questions. Then the auditor is going to be like, all right, this thing checks out. You're going to have a much better experience than if you come out of there without really knowing how to answer the questions or knowing how to provide documentation. 20 minutes remaining in our program. I know we have a lot of questions here as well. This next slide goes through finding the right partner. Adam, I'm going to let you take this one, and then maybe after this, we can spend some time trying to answer some of these questions.
Yeah, look, I mean, I think Matt, thank you. We covered much of this already. So I think from our perspective, we talked about, does the explanation make sense, right? Most importantly, does what you're hearing really jive with your gut feeling as to, is this something you should do? That you understand the level of risk that you may be taking, that's been adequately explained, that there's some kind of documentation that looks meaningful, looks material, that if you ever get a call from an IRS agent, that you can point to it and say, I understand this stance that I took on this very generous claim, this very generous refund, because it's a lot of money. And in many cases, it's the largest tax position that anyone of our clients will ever take. This is material. And so that lastly, obviously, the company will be around to defend the work if it ever does get audited. And that's probably enough for this slide. And I think we can dive into Q&A.
Yeah, let's do it. I'm looking at the top, and maybe Adam, you and I can just work through it. Number one, can you claim the ERC if you were the only employee? So you're the owner and the employee. The general answer is no. If you're a relative of the owner, generally those wages are excluded. There are some nuances that are explained in the IRS notices that create some exceptions to that are kind of odd exceptions, by the way. Like if you don't have any brothers or sisters or siblings, then maybe you're in, but if you do, you're out. It's kind of an interesting way the IRS has created these rules, but the general answer is no. If you're the only employee, then it's probably going to be excluded. Your payroll would be excluded. The second question is similar to that. What if you are a Schedule C sole proprietor? How do you claim ERC? Absolutely, you can claim it. If you are employing individuals, you've paid or remitted payroll tax to the IRS, maybe annually. If you're really small, you don't do it quarterly, then you are eligible to receive a refund of those taxes paid. In addition to that refund, you can go above and beyond. If your ERC claim exceeds your payroll taxes paid, because it is refundable, then you can receive the excess as well. But you do have to have that base of taxes paid. Going back to the contractor question, you don't get it on the contractor because you didn't pay any taxes on the contractor. You may have paid them indirectly to the contracting agency, to the temp agency, but that doesn't count. The temp agency is going to have to file their own 941X if they want to claim it on those employees. We claimed and collected the ERC. Is there an opportunity to collect more, or is it one and done? PPP was one and done, right, Adam? We saw that. They had a couple of iterations of it, but once you missed the deadline, you were done. ERC is retroactive. You can technically amend your 941 as many times as you need to. Our experience has been that's going to raise a lot of red flags. So as long as you're comfortable that you're doing what's right, but the probability of audit goes up significantly as you continue to amend and claim more. But we've seen that. We've done that for employers where they claim something, but they underclaimed it. We were able to help them find additional value. So we filed a new 941X, amending it yet again. So you can continue to do that. Just know that it is going to slow down the claims. It does take a bit longer to process that. And it likely will result in the IRS asking a few questions, understandably. If you are well-intentioned and claim the ERC but are turned down, is there a penalty? Turned down, as we talked about, would be during an audit. It's not, again, an application to receive it. It's just filing it on a tax return. They technically can have penalties in their toolbox if they want to use them. Penalties are usually reserved for taxpayers taking frivolous positions that aren't reasonable. If you feel like you have a risky position, you can disclose it on the 941X, and that should mitigate the penalty exposure. But as I said before, I think any oversights, any mistakes will be handled with some mercy by the IRS, considering the history here. I had a client where we made a mistake. We overclaimed the credit. We worked with the client, we worked with the IRS, we fixed it. There were no penalties. They understood it. We became clean though. They didn't catch us. We let them know, hey, it was a clerical error. The numbers were wrong, and we amended it. And it worked out well. already answered, can you claim it for contractors? If an employer paid their employees payroll out of the owner's personal funds, can these funds paid by employer be shown as ERC eligible? I suppose the source of how you make your payroll doesn't matter. It's really focused on the taxable wages, 3121 taxable wages, usually W-2 wages, and remitted on a 941. And so whether it was paid from personal funds or paid through a loan or paid through business bank account, it really doesn't matter. You're really going to focus on the 941 refund process of taxes remitted. Remember, it's a refund of taxes paid, not necessarily wages paid. But also, to clarify that, because we get this a lot, if you incurred additional expenses as a business because of COVID, that's not included in the ERC. The ERC isn't meant to reimburse you for expenses. It's really meant to be a refundable payroll tax credit.
And it looks like Watson has some, from Chamber has some additional questions for us. Watson, are you free to join and maybe ask away?
Yeah, sure thing. Although I do, there's one, I thought, a thoughtful question in the chat that I'd like to get to, and that's regarding the basis on which you calculate the credit. And the question is, are gross receipts used to determine the calculation by a tax accounting method or book accounting? I thought that was pretty interesting. What's your take on that?
Yeah, it's a great question. The definition of gross receipts is a tax definition. So I think the safe answer is generally going to be stick to how you define gross receipts when you're filing your taxes, when you're determining your income taxes and other taxes. Recognizing that you may have cash versus accrual depending on whether it's for your books versus tax, there'll be a book tax difference. But with the IRS definition, it should be using the tax definition, which is usually follow your tax method.
I did want to react to a comment you guys made earlier about how this is not normally how Congress does tax legislation. I would beg to differ. You tried to penetrate any of the provisions of the Inflation Reduction Act. Yeah,
that's fair.
Yeah,
that's fair.
So,
right.
Yeah, right. Yeah. So in that spirit, let's talk a little bit more about the risks and the sort of the peril that awaits folks who maybe listen to the "It's Too Good to Be True" ads you hear on the radio or see even on billboards or whatnot. What should small businesses owners look for? What qualities should they be looking for in selecting an advisor or provider to help them determine their eligibility, and then paper, if eligible, paper their claim? What should they be looking for?
Yeah, I think it's a great question. I think it's right. Do diligence, do research, ask good questions, be thoughtful about. I think by now, what's great and what we see from our clients is that there's no shortage of data points. So our clients or our new clients that come to us say, look, I have a friend who has the same business in the same city or the next city over, and they received a substantial credit. And I thought when they claimed that credit that was absurd, but they claimed it and they just got a check for a lot of money. And so I'd like to know if I'm also eligible for that, for that refund check. And I think it's asking good questions and using common sense, right? If you see a billboard on the side of the road that says laser eye surgery for $199 per eye, well, maybe, right? But maybe you want to ask some questions and say, well, what does that include? What kind of laser eye surgery am I getting for $199? Or maybe it's not $199. Maybe it's $1,000, but that's the lead in. So there's just the questions to ask that your gut as a business owner is going to lead you down the right path, and feel free to ask the questions. And if you don't get an answer that you're comfortable with, then maybe move on.
So common sense. I think that's what I'm hearing. Let's look at some of the major risks areas. So you guys mentioned, the lack of legislative history and ambiguity around, cessation of business. I'm paraphrasing here, and in relation to a government order, as one of the standards that clients or taxpayers are having difficulty interpreting and applying, what other headline risks are you seeing from your client base?
I think what I am seeing as far as headline risk are, again, an oversimplification of the credit requirements and a severe misunderstanding of the documentation required to support the credit. We've even heard horror stories, for example, of clients contracting with a provider who was able to provide a credit calc within days and never spoke to them, never talked to them about their business, never asked for data, just said, hey, we're done. You got a credit now. We've even heard of them saying, hey, I didn't give them payroll and somehow I got a credit. And so obviously those are red flags, but if you're a business owner, you may not understand why that's a red flag. You may not understand the nuances. So I continue to see that, and hopefully some of the media coverage will slow that down, but certainly still a risk.
All right, well, in that vein, what have you been seeing? I mean, I know we're still in the infancy of auditing these claims, but what have you gentlemen been seeing? What are the themes coming out through your experience in helping clients navigate the audit and exam of ERC claims?
Yeah, I need to be careful here because I don't want to be critical too much, but I do see that as an IRS auditor, they've had a little bit of training, but they haven't been working through this for the last 3 years like many of us have. And so sometimes there's just not as much understanding and not as much appreciation for the nuances yet. We've worked with auditors successfully through that, though. They've taken an initial position that, hey, I don't see this, like I don't see how that modification matters. And then after some discussion, some more documentation, they've come around. So yeah, I get it. I understand that now. So that's been just a part of it. I think it will continue to be a part of it as the IRS gets more comfortable with the nuances, understandably. And then the other thing is we haven't seen a lot of audits, which is perhaps noteworthy. Just not a lot, like a less than 1% so far, probably less than 0.5% of all the claims that I've worked on or even seen or heard about have been audited. So far it's been very low audit activity. Again, I don't say that for people to roll the dice on this Russian roulette of audits. I think everyone should always take tax positions assuming they will be audited, not hoping they're not.
Yeah, in that regard, is there a special statute of limitations that applies for purposes of ERC claims, and what is the effect of amending your 2020 or 2021 return have on that statute of limitations?
So generally, the statute of limitations for amending is controlled by the instructions to Form 941. You generally have 3 years from the last date, which is usually construed per the instructions to be April 15th following the quarter in which you amended. So if you're Q2 of 2020, it's going to be 3 years from April 15th, 2021, which is obviously coming up in less than a year now. And as far as the IRS audits, the IRS has a little bit more time from the date you file, usually 2 years from the date that you file the amendments. You can't wait to the last day of that period of limitations and file and think, hey, you beat the system. Now the IRS doesn't have any time. And the IRS has some flexibility depending on if they thought there was fraud there that they can extend that. And then I think what's interesting is we're also seeing in some of the recent proposed legislations, for example, in President Biden's budget discussions, there was a proposed bill. It didn't pass. This version didn't pass, but there was a proposed bill to extend the period of limitations to 5 years for all quarters. Right now, it's Q3 of 21 is extended for 5 years, but to extend all of it to give the IRS more time. So that was the budget purpose of that was to increase the budget by giving the IRS an opportunity to pull back more funds that were used incorrectly there.
All right, so it seems we're coming up on time here. I'm going to let you guys riff one more time on the importance of maintaining, of looking at contemporaneous documentation and then having everything neat and tidy before you file the claim. What are there key documents that you see are inadequate or practices, or what more would you like to say about that? Because I really believe that's critical here to getting to sustaining your position on audit.
Yeah, I can go first, Adam. Just re-emphasizing that number one, this is a very generous credit. It's a good thing, but it needs to be used within the parameters that were stipulated by the legislatures, and then again, some guidance provided by the IRS. If you can't document how you fit within those parameters, then maybe take a step back and rethink your strategy and whether you should participate. It's really just, as we've talked about, common sense. If it sounds too good to be true, it likely is. Maybe take a step back, maybe question if you're using a provider, what their premise is based on.
Yeah, and I'll add just a snippet from a conversation I had this morning with an industry that was not necessarily a down the fairway industry for ERC, but one that certainly has had eligibility in the past. And my question to the owner was, look, this is the statute, and here's where the guidance you could find eligibility. And my question was, do you retain records? Do you have operating metrics that you can dig out of your system, and you can then take those operating metrics and then help us tell our story? This is a facts and circumstances test. So while your business may not be completely down the fairway for an ERC claim or a typical ERC claim, the business was impacted. It was clearly impacted. And the fact that the client had really good books and records with respect to the operational data that supported that impact really told a good story. So look at where you impacted. Can you support it? And are you comfortable with that narrative?
Yeah, I think it all comes back to just common sense. There is a very, like as you mentioned earlier, is significant or not an insignificant benefit here to be accrued. And so that sort of begets more diligence, on the claimant's part. And in order to have confidence, you got to make sure you've crossed your T's and dot your I's. And I think the important thing is you find credible organization like Experian. I mean, that's part of the reason why I was supportive of doing this program to begin with, is that there is a lot of chat, a lot of noise out there, and I think it's wonderful that you guys are able to help separate the wheat from the chaff and show what a sort of responsible, judicious, professional assessment looks like vis-a-vis what you might see on TV or hear on the radio. So kudos to you, gentlemen. With 1 minute to go, I want to thank you for making time to join us today and for sharing your wisdom. For everyone who's watching, I hope this presentation answered most of your questions, and at a minimum, equipped you with a better understanding of the ERC and maybe help you make better informed decisions about your business's potential eligibility. Therefore, each one of you should receive some additional information from our friends at Experian regarding the ERC in your inboxes following today's presentation. And again, I would encourage you, when in doubt, please consult competent counsel or advisors like Experian. Thank you so much for joining us today, and have a wonderful rest of your week. Cheers.